I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, today we dive deeper into August and September's economic panorama and attempt to paint a picture with the information garnered from reporting season and recent data. There's been no shortage of recession talk lately. However, an in-depth look at August's data offers a compelling counterpoint to this narrative. Rising living costs and increased interest rates are valid concerns, yet specific sectors have reacted not just with resilience, but with verve. It's fair to say many analysts went into reporting season a little too bearish. Meanwhile, National Australia Bank's monthly survey of business confidence released on Tuesday last week revealed business confidence edging up slightly in August, remaining above average levels, and measures of trading conditions, profitability and employment all rose, with a broad-based uptick recorded in conditions across most industries. The data supports widening expectations that the Australian economy is on track to avoid a recession over the coming year. Returning to economic insights from reporting season, let's discuss the booming sectors. The global travel market, including airlines and luxury sectors, have demonstrated robust growth, a testament to changing consumer behaviour away from goods and towards experiences or services, as well as pent-up demand. Additionally, discount retailers have surged, marking significant growth. This trend is noteworthy and reinforces the trend we've seen of consumers trading down and/or reducing their basket size. Turning to the corporate strategies, there's a conspicuous aura of restraint. Few management teams are willing to unveil their forward strategies, and that's a trend that's been entrenched since the pandemic's advent. Although these revelations have been limited, the prevailing theme from those who have shared is one of adaptability and resilience. Companies were particularly boastful about managing their inventory. This cautious optimism is a useful barometer of where we might be heading in the next few quarters. Diving deeper into forecasts, and as we've reported previously, the projections for FY24 and FY25 earnings saw a slight downward tilt, reflecting perhaps a broader cautious sentiment permeating the analyst community. And I've often wondered, when a company misses analyst expectations, was that the company's fault or the analysts? The dividend landscape in August was, to be candid, less than ideal. It's clear from the past 2 years companies are increasingly reticent to increase dividends, preferring to either hoard cash and/or pay down debt. The looming question that remains is, are businesses preparing for more frugal payout ratios in the future and frugal strategies amid an ever-evolving economic backdrop? And this might not sit well with the ageing demographic, those baby boomers who are increasingly reliant on steady and ideally increasing income from dividends. Another trend within the investment community has been evident in a lean towards large cap defensives. But as many of these entities fall short of their aspirational valuations, that's putting it mildly, dependent as they are on ever-increasing growth rates, it beckons a broader question. Might we find more lucrative returns in small caps? Use the search bar on the blog to look up small caps and to hear our latest thoughts. Beyond the numbers, the qualitative elements present insights too. After examining a myriad of company results and their transcripts, a distinct narrative emerges. We're observing a departure from the recurring concerns of inflation and wages. Instead, there's a pronounced focus on financial robustness, funding strategies, and maintaining balance sheet integrity. August saw laudable performances from the retail and travel sectors, as well as building materials, but the month wasn't universally triumphant. It's clear a focus on quality remains the evergreen priority for investors who want to continue to outperform in the long term. Nevertheless, the overarching message remains clear. The economy, though undergoing turbulence, remains intact. And that's all we've got time for today. Continue to follow us on Facebook and X, and we look forward to talking to you again next week.